Good morning, friends. Today, in honor of Veterans Day, I know it was yesterday. Don't come at me. My power went out yesterday, so I didn't have a chance to upload my videos and all that. So I figured I'd just do it today. But in honor of Veterans Day, I did want to share something with you veterans that have a disability that you may be able to entitled to some property tax benefits. So I know thank you so much for your service first and foremost, and I am sorry that you have to have your disability, and my husband's right there with you. But there are some silver linings that I wanted to share, because I know we have a challenge in our lives that we took on keeping this country safe. And I know a lot of times, especially nowadays, we get a lot of flack for that, and it's just a hard time to be in. But the silver lining, now, if you have 100% disability ranking, listen up, because you may be entitled to not one, but two different ones, depending on what your annual income is. So stick around also, though. If you aren't quite at 100%, there is another discount that you may be able to qualify for, and I'll talk about that as well. So before we get into all the nitty-gritty details of that, I do want to share with you how property taxes are calculated, so you understand what I'm talking about, because these are exemptions that are the discounts that you're actually going to get. So to understand how that all works, we kind of need to know what we're talking about here. I do also have a 7-part series where I go into detail on property taxes in California, so I'll link the introduction email or article to that here, so that way you can take a look at that if you're interested to learn a little bit more about how all of this works. But here's just the basics that you need to know for this video. So California is what's called an acquisition assessed based system. This is important to know because this is how our property taxes are calculated. So basically what that means is at the time of acquisition, so like when you purchase the property or you inherit the property, basically when that property changes hands into ownership for you, that's the time you acquired it, right? Your property gets assessed. And the assessed value is pretty close to the fair market value at that time. Is a completely different animal, but it's usually pretty close to the same amount. It's not going to be exact, but usually pretty close to each other. Now, if it's completely like hundreds of $1,000s off, you can talk to your assessor and have them reassess the property to get a better one that's more in alignment with the market. And this is especially important when our market is shifting constantly. It's good to know about that. So because it's an acquisition assessed based system, some states will actually reassess your property every single year. I know Texas used to do this, where they would every year reassess your property, and that's what your property taxes were based off of. And it could be very frustrating when you're that's probably why they hate us Californians moving in and buying all these properties with cash, because we completely doubled the market in 1 year's time for property values. So assessed values skyrocketed. So you could have your property taxes basically double in 1 year's time. So that's a tough pill to swallow when you're paying your monthly payment, and then all of a sudden it doubles overnight. This can be really frustrating. I know Texas has done some tax reform. I think it's every 3 years that they reassess now, but that's just important to know. So if you ever do relocate to another area, this is how California works, and it's actually much better than a lot of states. So part of the acquisition based system, so that is your tax value. So let's say your property is assessed at $500,000, right? So that is your tax value. And we have what's called Proposition 13 that puts a cap on how much your property taxes can be. And it's 1% of that your tax value, subject to increase at 2% annually. So the most that your property taxes can increase is 2%. And that is it. And we are not going to ever reassess your property until you change ownership. So this is why it's really important to talk to an estate planning attorney and things if you ever move your property into your trust, or and if you're giving it to a child or something. There are very specific forms and things and deadlines that you have to be in compliance with to make sure there's no reassessment done, especially if you bought your house in the 70s, you have that your tax value at $100,000 and it's now worth $1.5 million, and you don't want to have to get it reassessed at $1.5 million, because now you're going to be paying taxes on that. And this is exactly what I used to help my attorney with when I was a paralegal at the estate planning law firm. So this was this is the majority of what we did when there's going through estate planning and trust administrations, to make sure those issues didn't happen. So again, that's why people pay the big bucks. He charged $500 an hour to know this stuff. So That's why it's important, if you are in this situation, definitely talk to an attorney, because I'm just here giving you the basic information. But if you want specific advice based on your actual situation, you do need to speak to an attorney to get actual legal advice. So as I was saying, we have that Prop 13 that gives us that cap on how much we can get charged for our property taxes. Another part of that is we do have special taxes, or also what you've probably heard of, Mello-Roos taxes. Essentially, it's just a workaround Prop 13 to allow to pay for like emergency services, and sometimes there'll be school bonds. I know a lot of new home construction communities, like in Dixon and Rancho Cordova, that I've noticed, they will charge a Mello-Roos tax to pay for the infrastructure. So what they'll usually do is have like the local city pay for like the storm drains and sewer lines and all of that. And then once the community is built and then each homeowner purchases a home in this community, they're just basically paying back their share, their portion of that infrastructure to the city in the form of a Mello-Roos tax. And it's usually about a couple $100s a month. And this is why I'm always talking to my buyers about looking at your total monthly budget, not your total house payment and what you're pre-approved for, but that monthly budget that you have, how much you want to be able to spend, and not go over that. If you have the Mello-Roos taxes, also solar panel leases are a very big thing. That's like $100 a month. It depends on the community again. And then also any HOA dues, anything like that. So just be aware of those different situations. And that's why I always talk to my clients about monthly budget. And then back to what I was talking about. So once you understand, now that we know how property taxes are calculated, also about those property taxes, for the special taxes, don't be too alarmed though, because like for instance in Ione, it's 1.8% total for your property taxes, about that. So that Mello-Roos taxes is about 0.8%. So it's really not that big of a deal in most areas, but again, those new construction communities, be aware that that's something they might do. Anyway, so back to what I was talking about for the exemptions, that you might be able to get a discount on your property taxes as a disabled veteran with a 100% disability rating. You have two options. So the first one, it's a $4,000 exemption, and it's very limited on how many assets that you can own when you to qualify for that one. So I don't know exactly how that works. If you are owning your home and you have equity in that, you probably are already over the threshold. So I'm curious to know about that. But it really doesn't make a big difference, because in California you're only allowed to have one exemption, and there is another one that most Californians qualify whether you're a disabled veteran or not, and it's a $7,000 exemption. And so already it's going to be more than that $4,000. So if you're trying to decide which one, the $7,000 is obviously much better for you. And then the second one that you can qualify for as a disabled veteran, there's two tiers to it. So the first one is a basic exemption, and that's $100,000 off your property taxes. So basically how this works is they're going to look at your assessed value and take that discount off of that assessed value. Remember that base your tax value that you're being assessed, your property's taxes are based on. So instead of, like for that California exemption, for example, $7,000 off that total assessed value would be $493,000. But with this basic exemption for disabled veterans, that's $100,000 off. So instead of paying taxes on $500,000, you're paying taxes on $400,000. Big difference, right? And then there's another one. Now this is based on your income. So there is a cap on how much you can make annually to qualify for. But if you do qualify for it, it's $150,000 off your tax value. So instead of paying taxes on $500,000, it's now $350,000. So it is a pretty good discount. Again, it's still not 100%, but it is better than nothing, right? So if you want to know more about this, again, I'm going to put a link below for my introduction to my 7-part series, so you can kind of get some more information. And then also check your local assessor's website. They have quite a bit of information for you and what other programs they might be able to have in their area, because every county is a little bit different. And then you can also go to California Board of Equalization, and they have more information on this as well. All Californians that qualify. So, and you also, if you have any questions, feel free to leave them in the comments or contact me at stacyryder.net/contact. And I'd be happy to help you through navigate, like any questions you have. And if you need to talk to an attorney, I have some great recommendations I can give you and things like that. Have a great day, my friend.